You're listening to the Multifamily Market Watch for Washington State. Apartment owners who need to know, trust HFO. The leading source for multifamily industry news around the state, from Puget Sound to the Tri-Cities.
With me today is Carl Whitaker of RealPage Analytics. Thanks for joining me today, Carl.
Thanks. Pleasure to be here, and appreciate you taking the time to chat.
Well, I know as you're traveling around the country and you've been doing all kinds of presentations, you've had some involving the trends in the Pacific Northwest. But first of all, why don't you tell us a little bit about yourself and your company?
Yeah, absolutely. I'll try to keep it pretty short and sweet here, but happy to expand if needed. So the company is RealPage. We're a software as a service provider and covers really the full gamut of multifamily operations, investment management services, revenue management, et cetera. The part of the company that I work in specifically is our data and analytics division. And my function within the company specifically is our research and analysis for all of the markets, economic trends, and how those economic trends influence multifamily housing market performance. So we really focus on a lot of those market trends, what's happening with supply, demand, rent growth, occupancy, et cetera.
And you have recently given some webinars that involve trends in the Pacific Northwest. Is that right?
We have. Yeah, we did a webcast recently on the West Coast markets, and we like to spend a little bit of time there in the Pacific Northwest in particular. So we covered Oregon and Washington metros.
And were there specific things that you can recall from those webinars that you want to share with us today?
Yeah, absolutely. So I'll start regional and then happy to, dive into specific markets. This is probably no surprise to folks listening on the podcast here, but we all know that the Pacific Northwest was one of the regions of the country that was hit really hard by the 2020 COVID pandemic. And, it translated to really soft occupancy, rent cuts for a lot of these markets. What we've seen since then, however, is that many of the Pacific Northwest markets have actually recovered really well. You're starting to see job growth come back to these markets. You're seeing some of the folks that had maybe left those areas just did so temporarily and have now started to come back and are once again renting in places like Seattle, Portland, et cetera. So again, we've seen that the region has really stabilized very well. Something that came up as a kind of an interesting sub-trend, if you will, was that we've seen that the urban cores within those markets have really still yet to gain a lot of positive and sustained momentum. Looking at Queen Anne, South Lake Union in Seattle, for instance, or looking at the downtown Portland area, we see that those subsets of those markets are still lagging their suburban counterparts, but by and large, many of the suburbs and those two metros in particular are really back on track and performing in line with pre-pandemic norms, if not even slightly outperforming in many ways.
And do you study transaction and sales volume at all?
We do, yeah. So our partners over at Real Capital Analytics provide us that data, but we do keep up with the transaction side of the market as well.
And what do you think with the interest rates going up lately and going up likely for the next few months? Do you have any forecasts for the future for the remainder of this year and early into 2023?
Yeah, it's a great question and one that kind of requires a crystal ball that I wish I owned. But I think our thoughts on the market. We talk to owners and operators in the area quite a bit. We talk to investment groups as well, and what we saw was really in the summer months, the transaction side of the market kind of took this strange pause in many ways. It certainly wasn't to say that there was no transaction activity, but transaction volumes really tapered off quickly in the summer months. Since then, we have seen some, returning investment activity, still not quite to where we were at the pandemic peak back in, let's say, early 2021, but I think what it really signals is that there's a lot of growing economic uncertainty out there right now. You mentioned the rising interest rates and how difficult that is to really get your arms around. I think that coupled with this looming fear of some economic contraction, if that does materialize, has really caused investors to be a little bit more prudent in their approach on acquisitions. And, as far as what that means for 2023, 2024, I think we're going to want to see what happens with two components in particular. If you look at NOI, we all know that there's operational and income components of net operating income. And we do expect that with performance moderating in many of these metros, that you're going to see softer rent growth. You're going to see occupancy starting to level out. The question becomes what happens on the operational side of the equation. In other words, do expenses, the pace at which those have grown, also start to moderate? And I think investors are really kind of waiting to see what happens there, because with many of these markets seeing sub 4% cap rates, I think investors are being a bit more prudent in their approach in many ways.
Did you have any other specific information with regards to any of the markets, including Spokane, Tacoma, Olympia, Everett, Seattle, or Vancouver, Washington? Are there any things in particular that you remember running across for those areas?
Yeah, for sure. One of the things that's kind of struck us is a trend that we didn't know whether was going to be here to stay or something that was just a short-term blip on the radar. But what we've seen is that some of those, let's call them satellite markets to Seattle or even Portland, have started to forfeit some occupancy a little bit quicker. And I think what it might signal is that a lot of the residents that maybe moved out of Seattle into one of those neighboring markets in an effort to save money, the work from anywhere environment, as the quality of life in some of those markets has come back, such as Seattle, we've actually seen a kind of a boomerang effect where, somebody that maybe moved from Spokane or moved to Spokane rather during the pandemic is maybe moving back to Seattle now. So, I think the big surge that you saw in some of those secondary markets is starting to normalize. Now, we still have a glass half full perspective on some of those markets like Spokane, and I'll even extend it a little bit further. I'll take the liberty of including Boise, Idaho, and the Pacific Northwest. But we're still glass half full long term on a lot of these markets. But I do think near term, let's call it 12 to 24 months, with as much supply delivering as you're seeing, you're going to see Class A product in particular kind of go through an adjustment period. We saw absorption rates have really fallen over the past 6 months. Retention is still high, but absorption is falling. And I think you're going to see some leased up properties maybe dipping a little bit deeper into their concession bucket in an effort to fill those units.
Well, Carl, any other insights you have to share with me before we finish up this morning?
No, I think that's it. I would just quickly mention for any of the listeners, if you're interested in seeing some or hearing some more insights on the markets, we have our realpage.com/analytics blog where we dive into markets really of all sizes and talk about performance readings there. So feel free to check that out. And if anybody needs to reach out to me directly, feel free to do so via LinkedIn, and I'll be happy to talk to them.
All right. Carl Whitaker, Director of Research and Analysis at RealPage Inc. Thanks so much for spending some of your time with us.
Thank you. Appreciate it.
All right. So with me today is Blake Hering of Gantry Inc. Thanks for joining me today, Blake.
Gladly.
Well, things have changed once again in the last month in the lending world. So what's the latest?
So the latest is that the Fed once again raised their funds rate by 75 basis points. So that's a total of 375 basis points that they've raised rates this year.
Wow.
That is unprecedented. And at this point, the market expects at least another 25 or 50 before the end of the year. So I guess to put that in some context or perspective, one, it's never been done. And two, if we'd had this conversation a year ago, you'd have said I was crazy if I said the Fed was going to do it, which of course I couldn't have predicted. But
Right.
I think where we're at now is just a new reality, frankly, what the market's is going to have to come to terms with. It slowed business down, and we're now going to have to just see how buyers and sellers reconcile this adjustment, because it undoubtedly has an effect on values. And does an income stream and commercial real estate still hold value relative to other investments in this kind of market.
Mm-hmm. Yeah, there will be some changes ahead. Exactly what those are.
I mean,
I think
that's putting it lightly. Yeah,
we'll just have to see how that shakes out. Wow.
But like I said, I mean, it is the new reality, and now it's just a matter of adjusting to it. I think that, many of those people who had hoped that the Fed would back off and things would change or turn around, have had to had to face the reality that the Fed has stated emphatically that they are not. And while their pace of rate hikes may slow, it's unlikely they will do another 75. But it is likely that they may continue to make some adjustments upward in order to, counter inflation the way that they want to. I mean, ultimately, they want to get inflation down to around 2%, and we're certainly a long ways from that now.
Okay. Well, until we speak again next month, is there anything else that you wanted to add about, I don't want to say predictions. What else? Yeah, I mean, I'd like to obviously end on a more positive note, and that is that there is still plenty of money out there, and there are still plenty of lenders who want to loan on commercial real estate specifically and particularly apartments. And while rates have adjusted now to, and kind of a 6%-ish range, you can still obtain rates below 6% for modest leverage deals. And again, there's no shortage of appetite and availability. It's just finding the appropriate fit at this point. All right. Well, Blake Hering of Gantry Inc., thanks so much for joining me today, and we'll speak to you again soon. Great. Thanks, Aaron. Thanks for having me.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 206-705-5115 or visit our website at hfore.com for more information. HFO is an affiliate of the Global Real Estate Advisor Network.